we're competitors for investor dollars, but we're all in this space to make it work and to make it good. And it's the way the provincial bond market works generally, is that we all need the provincial bond market to function well. It's a much more collaborative space. And I think green bonds and social bonds as we move forward will have the same kind of feel.
Welcome to Sustainability Leaders. I'm Michael Torrance, Chief Sustainability Officer at BMO. On this show, we will talk with leading sustainability practitioners from the corporate, investor, academic, and NGO communities to explore how this rapidly evolving field of sustainability is impacting global investment, business practices, and our world.
The views expressed here are those of the participants and not those of Bank of Montreal, its affiliates, or subsidiaries.
My name is John Uhren. I'm a managing director in sustainable finance at Bank of Montreal. It is an interesting time to be in sustainable finance. It felt like just a couple of years ago, every corporate with a pulse was making net zero greenhouse gas emission commitments. The sustainable debt market was, close to $2 trillion annually. At least we saw that in 2021. Felt like every asset manager was making, commitments around net zero across their portfolios. Every loan was becoming a sustainability-linked loan. The Leafs routinely missed the playoffs. I'm from Western Canada, so those were good times. Those were great times across the board. But here we are. It's 2025. And, we have a lot of headwinds from a legal, regulatory, policy, and markets perspective. But thankfully, we have three experts here with us today that are going to cut through all the noise and break everything down and make it quite simple for us. So first off, I'll do some introductions. To my left is Elizabeth Wallace. Elizabeth is the Senior Manager, Capital Markets Division at Ontario Financing Authority. The OFA is responsible for borrowing, investing, and financial risk management for the province of Ontario. Elizabeth's a member of the OFA's funding team, responsible for capital market activities, as well as Ontario's new borrowings and existing debt portfolios. And importantly, she has been actively involved in the province's green bond and now sustainable bond program since its inception. To her left, we have Barbara Zvan, who's president and CEO of University Pension Plan. UPP serves over 41,000 members with a focus on lifelong pension security and service excellence. Barb has been named both Canada's CEO and Corporate Citizen of the Year by the Globe and Mail. And she's a leading advocate for defined benefit pensions as well as sustainable finance. Previously, she was the Chief Risk and Strategy Officer at Ontario Teachers Pension Plan. And finally, we have Simon Senecal, who's portfolio manager, responsible investment, as well as partner at AlphaFixe. As PM, Simon works to develop sustainable bond strategies that position AlphaFixe among leaders in responsible fixed income portfolio management. Simon also oversees the integration of ESG factors and climate risks into the investment process. Barb, I want to start with you. Curious to get your views on the outcome of the election, particularly from an asset owner's perspective.
Sure. So just to give you some sense, UPP owns about half its assets in Canada when you look across the bonds, real estate type portfolios, and we have our share of the equity market. So we're cautiously optimistic, or I will say I am cautiously optimistic. Last Friday, Prime Minister Carney outlined his immediate priorities, which, for a long time, pension plans have been advocating to remove internal trade barriers across the provinces, which goes to, him saying that he's going to help work with provinces and territories to identify national projects, which is great, working across party lines, and involving the private sector into those infrastructure projects. And so, that is a really interesting proposition from someone who has Canadian dollar liabilities that are indexed to Canadian inflation, and also his focus on housing. Right. And this is also a great asset class for pension plans. Think of multi-family apartments. That is a perfect asset for pension plans if you can get the right conditions. So on that side, it's great. He has a natural lens to ESG, so all things environmental, social, and climate. So, I'm going to presume that will all be factored in as he lays out his plans. But if you go into the earlier plan work for the Liberals, part of my past role is being part of the expert panel on sustainable finance in 2018, 2019, and then the ongoing 3-year initiative that ended last year, which was called the Sustainable Finance Action Council. And it was 25 of Canada's largest financial institutions. So you had the banks, you had the insurance, you had pension plans there, you had also a few niche managers. And really, we provided the government solid recommendations, which you actually see in his platform. First and foremost, Canada needs a taxonomy. So think of what is considered green as well as transitioning. We put out a recommendation on that in 2022. So we're in 2025. So, and I can tell you all 25 financial organizations backed that proposal. He also backed the need to do disclosure. So think of ISSB, International Standards, Sustainability Standards Board. I'm going to presume most of the room will know who that is. And S1, S2. We also had the Action Council say that that should actually apply to the whole economy, public and private in Canada. And he also mentioned the need to de-risk investments, so blended finance. And if you look at the work of the SFAC, one of the last things we did was publish a paper on what are the ways that we can do blended finance to bring in more private dollars. So cautiously optimistic. I know he has a lot on his agenda, south of the border especially, but hopefully he empowers people to get these things done.
I'm also cautiously optimistic. I think that's a good way of putting it. There seems like such an emphasis and focus on what happens in the US, right? Where it's almost like we have this addiction to the US, and this is globally across all markets, but certainly as it relates to sustainability. And that can be discouraging. But from your perspective, what would you say globally, for one, is working well globally that you've observed around sustainable finance and sustainability writ large? And then in Canada, what's working? And you mentioned SFAC and others, but curious to know some of the other initiatives that you see working well in Canada.
Yeah, so maybe some global highlights. Renewable energy power generation will now surpass coal this year. Okay. So that's great. China's coal use was down 4% over this quarter, same period as last year, and solar was up 45%. EVs, someone told me last week at a dinner that the BYD factory in China that they're building is bigger than San Francisco. Just think about that. Right? And, if you think of really complex situations, think of the IMO or the International Maritime Organization, they have figured a way to do carbon pricing for shipping. Think of all the groups that actually had to agree to that, to get that in place. So those are exciting things in the real world. In the fixed income world, I think that, ISSB, that is now at 30, when they published their 2024 annual report, it's 35 jurisdictions are either adopted it or adopting it. That represents 40% of the world's market cap and 60% of the global GDP. So it's coming, right? And then that is not for accountants. That is started by investors, right? And SASB, which was S1, was started in the 2000s. I had the pleasure of serving as the second chair for the investor advisory group. Was the easiest role I've ever had, picking up the phone and saying, do you want to be part of this? And we had hundreds of investors around the world engaging with companies to adopt it in the 2010s. So this is why it has become the standard and why you see the adoption already quite high. I think your own BMO GAM report said that 50% of the TSX composite are already doing a lot of work around climate and reporting. Over 80% are reporting as their scope 1 and scope 2. So it's here. It just needs to be solidified. In terms of driving impact, I'll call out two initiatives. One is called Climate Engagement Canada. How many people have heard of it? Couple. Okay. So there is a global initiative called Climate Action 100+. It takes 600 investors. You might see it on the news where different folks have left, but it still has over 600 investors globally engaging with about 160 companies about having a strategy to align with Paris, disclosure, governance, lobbying, sector-relevant metrics. So part of the expert panel, we said, wow, that's over 30 Canadian investors there, but only 6 companies. We should actually do something nationally. And so we have targeted the 40 highest emitters in the TSX outside what's in Climate Action 100+. We have now over 54 investors, $8 trillion organized in teams engaging with these on the exact same things and doing the benchmarking as a roadmap. So, what we're seeing there from a disclosure perspective, we're actually on par when you give people partial marks, not full marks, but partial marks. So, globally, we're there on disclosure or on the path. But where we really are challenged when we know this, when we're engaging, is the commitments around how to get to aligned with Paris, decarbonization strategies, long-term targets. We're woefully behind global peers. And often what we hear is that, we don't know what good looks like. 48% of the companies on the S&P 500 have science-based target aligned decarbonization plans. Almost half. We stand at maybe a quarter of the TSX. So we're still woefully behind even those in the South. And that brings us to the newest initiative that will be soft launched next week called Business Future Pathways. We're trying to mimic the best of ASFAC, the Action Council, bring together financial groups, about 20 of them, a technical group, and start showing what does good transition plans look like in 2025, 2026. And that's something that we're pretty excited about. It's a 2-year initiative and really will help us engage with companies and illustrate what are investors expecting when we talk about these things.
Thank you for your comments. I'm cautiously more optimistic based on most of what you said. Some of the stuff around disclosure I'm concerned about and commitments and transition planning, but it sounds like there's a lot of work underway. So it's all encouraging to hear. And maybe I'll transition to you, Elizabeth, especially as we think about optimistic outlooks and think about your very robust green bond program, 18 green bonds from the province, 21 billion, I believe, in total supply, the largest issuer in Canada. And just want to kind of unpack a little bit more around your program, some of the challenges that you've seen over the 11 years of the program, some things that have worked well, some things that haven't worked so well as you built your program.
Okay. Well, I think I'll start with the challenges because I think it's the most interesting topic and probably the one that unifies us as a panel. Of all the challenges the program has faced, the one we're facing right now, everything's in sort of flux at the moment. But our program has always been very investor driven. And so I think what the way ahead will look like for us is very much an uptick in investor engagement to take the temperature of what's still working for them, what are they still interested in. But it's a really challenging time in that regard. And last year we had a 10th anniversary. We crossed the $20 billion mark. It was a lot of internal momentum and celebration of how far we'd come. And it's always important to take these moments to celebrate when you have these milestones in these moments. And I think last year was a good example of doing that because if we'd waited till this year, the temperature is dialed down quite a bit. So coming off of that high, having done our first 30-year green bond, we now have green bonds in the market that range in maturity from 2 to 30 years. So a very, full curve to deal with for investors. And I think that's been a real positive. And when I think where we started, I describe it as a cloud, the green bond market at that time. It didn't have very, very firm edges to it. And that's something that through our engagement with the principles being developed, with investors and what they would want to see in a program, all of that sort of got a little bit more shape and a little bit more certainty around it so that, we have principles, we have second party opinions, we have taxonomies. And then we did have a change in government over that time period. And we went from the government that had been in power when the Green Bond program was launched, and they were very supportive of it. We had a change in government, and with any change in government, the first thing they do is review the policies of the previous government. And so the Green Bond program was put under the microscope in 2018 by the Conservative government that came into power, and there was a lot of dialogue around it. It wasn't an automatic check mark. It was probably closer to an automatic into the waste bin kind of thing, but by doing a fair amount of education with what it was and what it wasn't, the government could see where it aligned from both a business and an environmental perspective with what their objectives were coming into power. And they remain extremely supportive of the program. They're very proud of the program. You'll see our finance minister speak of it in almost any public forum where he's at a dais. You'll see our CEO talk about it. You'll see our Deputy Minister of Finance talking about it. And even when we've had changes to the Finance Minister or the Deputy Minister, the new one comes in, learns about it, gets excited about it, and puts it into his speech as well. So I think there's a lot of internal support, and hopefully that'll give us the momentum to face what is the current environment, because it does feel very uncertain at this time.
And as part of that uncertainty in the current environment, there's obviously sort of the high level sort of headwinds, but around greenium. So the fact that we haven't seen a lot of greenium in new issues, your bonds, but frankly, all labeled ESG bonds in the market were almost a disappearance entirely. So is that something that has caused some pushback, or has that led to any uncertainty internally as to whether to continue with the program?
At this time, I would say no. Obviously, the greenium is a big part of the program for us. We've never really pushed it. We've tried to be very respectful because we want investors to meet us halfway. And taking every penny off the table is not generally the way to endear yourself to investors. So it's a bit of a dance between ourselves and investors as to where the settling point is. And we've always been very particular about not actually giving a numeric greenium in our own sort of communications that we put out. And so we'll see where this year takes us. We've been successful with keeping a tiny greenium on most of our issues, so we'll see if that's still possible. But the environment is changing, and we'll have to change with it, and I don't know what that will mean for the future.
Fair. Simon, I'm going to come to you now, and I'm going to ask you the flip side of that question in just a moment around how you approach the greenium and paying through the curve on issue. But maybe first, just if you could talk, a little bit about your ESG fixed income buying strategy. And I know there's a healthy dose of ESG integration involved in it as well, but I think you guys are like north of $2 billion in ESG bonds purchased. I think it's a third of your portfolio, a third of AUM. So major part of your overall strategy. Can you tell us a little bit more about your buying program?
Yeah, and I agree with you, by the way, with the optimism that we kind of feel on stage here. And I'm an eternal optimistic, but that helps. So what we do at AlphaFixe is that we have a dedicated team in-house to analyze ESG risks. We also evaluate sustainable bonds. They're not all sustainable because they have a label. So to start with the ESG integration, it's done quantitatively. It's integrated into our own credit rating. So it affects directly portfolio construction. How it's done is that all else equal, a higher ESG score will yield a higher credit rating and will give a higher percentage of the issuer in the portfolio. Again, all else equal. So it's important to look at all of the sides of a new deal. Like we need to make sure it's well priced. So given the risks, given the credit risk at the moment, we also buy on the primary market. So of course, new issues will participate the great majority of the time, given that we're comfortable with the credit situation of that issuer. And we also, whenever we onboard new clients or we have a new contribution of an existing client, of course, we need to do that on the secondary market. So it can be substantial contribution, and still we don't find it hard to find the supply on the market. And maybe I'll end by saying that sustainability-linked bonds for us aren't seen as being sustainable bonds. We see them as regular bonds, and since they're general corporate purposes bonds, they fit in our regular portfolios if the price is right, but we won't put them in our sustainable bond strategies.
Interesting. We haven't seen many sustainability-linked bonds anyway.
Less and less, actually.
Yeah, less and less. But interesting to hear from you that you don't consider it sustainable anyway. It's good for us to take back to our clients. So question then on the economic side that Elizabeth is talking a little bit about the greenium. How do you decide how and what to pay and whether to pay through the curve on a labeled ESG bond?
Yeah, so I'll start from what Elizabeth mentioned as a tiny greenium. Like that's how we see it. I'll put in context that in regular bond strategies in a universe mandate, we need to add 50 basis points to our benchmark. It is the same for sustainable bond strategies. So in that context of 50 basis point, if we have an issuer that comes to the market with half a beep across their curve, this is not material to us. It doesn't move the needle. It won't affect our active management strategies. That being said, we have seen in the past some issuers coming to the market and explicitly saying that they wanted to save like a few beeps with that sustainable bond framework. We think it's very important to be vocal about our needs and the fact that pricing needs to remain in the context of the existing curve of the issuers. Otherwise, I think we'll have a problem with like the growth of that market going forward.
Barbara, I want to come back to you. And again, just picking up on the theme of the new prime minister, some of the campaign platform pledges that he made, and two noteworthy ones for this audience: $10 billion in transition bonds starting in 2027, as well as sustainable investment guidelines, which is the green or transition taxonomy that you were alluding to be announced, I believe, for a minimum of 2 priority sectors, but we think, across sort of 7 priority sectors in the fall of 2026. What are your immediate thoughts or reactions to these commitments? And do you see any issues in implementation?
To me, it's like, finally, perhaps. So if I maybe reflect, Japan right now, a couple of years ago, committed to do about $120 billion of transition bonds over a 10-year period. So it's in the right order of magnitude. And what's been interesting is that there's a lot of controversy over it, mainly because they didn't go the route of a taxonomy. They kind of did these sector kind of pathway template notion. So they kind of veered away from what's becoming normal market infrastructure. So most people just tend to think about the EU taxonomy. Actually, China was out first. And there's about probably in the order of 50 taxonomies today developed or developing across the world. So this is normal market infrastructure that Canada does not have. And so thus the recommendation, and it brings clarity and confidence to what you can do in terms of transition issuance, because it's a little tricky. And that's where you need to bring in the experts and bring in technical committees and a formal process. Just to give you a sense, it's, the taxonomy was recommended in 2019. AlphaFixe started in 2021. Our paper went pens down in 2022, publicly posted March 2023, and we finally got an announcement last fall in 2024. So I get the frustration of the real economy about getting projects done in Canada. That is a long time. And so, but the fact that it's 15 months, I still think it's plausible. And I will point to Australia. So between the time we went pens down and it was published, we handed our paper to Australia. We were on late night calls, and they actually published our framework first. And they took it and they've been working on it. They already have out, as of the end of the year, their 6 priority sectors. That is the full work, including do no significant harm elements on electricity, minerals and mining, buildings, manufacturing, transport, ag, all the same sectors that we are focused on. So it can be done if you put focused resources to it. But I would think the biggest challenge is empowering a group to get it done.
I remember when Australia had first published their taxonomy, and it had the same language and lines, like some of it was word for word from a lot of the work that you led and others were involved in myself.
Couldn't even reference our material because it wasn't published yet.
Yeah, it's sneaky. Simon, I want to come to you again, though, just because on the theme of transition or decarbonization, I know we've talked a lot about your green bond fund, but I know there's some work internally at AlphaFixe around standing up a decarbonization bond fund, which you've called sort of ESG 2.0. If green bonds are 1.0, this is sort of 2.0. Can you tell us a little bit more about the fund and when we expect to see it?
Yeah, and first of all, that comes from the frustrations of waiting for guidelines. So you'll see in that thesis where we stand, that what Barbara mentioned, like we feel it deeply. Like we've been talking to the expert panel group, like we had talked to them, I think it was back in 2018. Was it? Okay, so there you go, 7 years. So yeah, as you mentioned, we had success with the Green Bond Fund that was launched in 2017. That led us to finance billions of dollars through other strategies that we launched of fully dedicated sustainable bonds since then, because the demand is there from asset owners. It is there. So to Elizabeth's point, if asset owners want it, managers will buy the bonds and it makes a business case for issuers. So that being said, green and strictly green is good. We need it. But since the International Energy Agency's net zero in 2050 scenario mentions that we'll have more than 20% of the total worldwide energy production that will be from fossil fuel in 2050, I think we need to work also on decarbonizing hard-to-abate sectors, including fossil fuel. Problem is, if you mentioned like taxonomy, like transition, decarbonization, what I'm thinking when I put these 3 words together is that there's a lack of guidelines. So issuers and investors are willing they like the concept of decarbonizing hard to abate sectors, but the lack of guidelines. I'll give you an example. If we ask here 5 sustainable finance professionals what their definition of transition is, we'll probably get 4 or 5 definitions. So my point is, let's call this decarbonization. It's very simple. It's just lowering your carbon emissions. There's less risks of misinterpretation, therefore less risk or no risk, if you ask me, of greenwashing. So that being said, where are we now in our thinking and putting together this fund? Is that we have drafted an investment policy. We are talking and we have talked to potential investors. We also drafted a list of potential or eligible projects. So the green bonds, we have the climate bonds taxonomy that's very strict and clear, as I mentioned, for green. But now will we wait? I think you were optimistic, Barbara, in saying that the government will, they committed, but they had committed in the past and we're still waiting. So what we're trying to do is to work around that and convincing investors and issuers to work with us. So that means we're willing to work with our competitors. So we're willing to do this. The way we would do it, there's 2 separate set of criteria that we would look at. First of all, we would need issuers to be 1.5 degree aligned. So as Barbara mentioned, there are already a lot, maybe less in Canada, but just with the ones we have now in the bond market in Canada, it would allow us to build a portfolio that's diversified, that gives us enough flexibility to beat our benchmark, just like we do with the regular bond strategies. Then second set of criteria, this is where there's a bit more innovation and where it's a bit more tricky to convince people. What we would do is talk to issuers and want them to issue use of proceeds unlabeled decarbonization bonds. There's many words in there. All it means is that we would get a confirmation from the issuer, treasury group, whatever. It could be just an email. We don't have to be fancy about it. So then we would have a use of proceeds bond that's like a transition bond, just without a label. We have done this in the past with green bonds, by the way. So there are issuers out there that have green bonds that most investors are not aware of. So it's simply by talking to issuers and knowing where the proceeds go. So that happens already. So it's not that much of innovation, but we need more investors to be on board with us. So as I have many friends in other investment firms, and we need them to come together to tell issuers all together that we're there to buy these bonds. This would create a channel for capital flow to go towards decarbonizing hard to abate sectors. So these 2 sets of criteria would also give us leverage to engage with issuers. So first of all, the 1.5 degree aligned that we're lacking in numbers or in percentage compared to other countries, we would engage with the issuers, telling them to ramp up their game and to meet their competitors or their peers at the top leading their industry. So that's first. And then we would engage with other issuers that have projects that could fit in that decarbonization bond idea. So the goal is to work together across Canada to make it happen, because even though I'm super optimistic in general, I'm very pessimistic about us meeting our net zero commitment, because we're on a 3, 4, or even I heard 5 degree trajectory lately. So that's the idea of AlphaFixe, of how we can contribute to that goal.
Great. Thank you. Elizabeth, back to you now. You added social categories to your green bond framework, making it a sustainable bond framework last year. Any interest, thoughts, or views around issuing either a labeled sustainability or social bond in the future?
That is requiring some internal work to get our processes in place for that. So there is intention behind adding those categories. When we put the 5 social categories in place, we also evaluated whether we should have a specified category for Indigenous finance in there. And as we were looking, realized that our social bond categories are employment, healthcare, education, housing, and infrastructure, and that those are all relevant in the Indigenous space, but they're also relevant for a number of Ontarians who are in underserved communities or part of vulnerable populations, etc. So our social bond categories are meant to be for all Ontarians. But yeah, I'm excited to expand the program, especially because we have been able to I think, provide leadership in the green bond space in Canada. And because we are such a large issuer and have a fair amount of, I guess, reputation, that we know what we're doing when we come to market, that we take what we've learned in one market and apply it to other markets, that coming into the social bond space, we'll take all of that knowledge that we've built over time and apply it there and hopefully have a successful way in. We'll pave a path so if others want to follow, they can. Similar to green bonds, I was funny hearing some of the comments you were making about the SFAC. We shared our green bond our green bond framework with so many people who, I can recognize wording all over the place. Same thing with our processes. We met with a number of people who were saying, how did you do internally, like the use of proceeds, tracking of funds? What is your reporting document that you have all the different projects using? I mean, that's if you lift the hood of all the different cars that, our green bond programs, we all have the same kind of engine and carburetor and everything. And we have zero problem with that because, to Simon's point, it's a collaborative market. Like, we're competitors for investor dollars, but we're all in this space to make it work and to make it good. And it's the way the provincial bond market works generally, is that we all need the provincial bond market to function well. So there's no margin in sort of elbowing someone out of the way. It's more about figuring out like who goes first, who goes second. It's a much more collaborative space. And I think green bonds and social bonds as we move forward will have the same kind of feel.
Thank you, Elizabeth, Barbara, Simon. Appreciate your thoughts today.
Thanks for listening to Sustainability Leaders. This podcast is presented by BMO. You can find our show on Apple Podcasts, Spotify, or your favorite podcast player. Press the follow button if you want to get notified when new episodes are published. We value your input, so please leave a rating, review, and any feedback that you might have, or visit us at bmo.com/sustainability leaders. Our show and resources are produced with support from BMO's marketing team and Puddle Creative. Until next time, thanks for listening and have a great week.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.